Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Welcome back, stock investors. You know what time of the year it is. It is earnings season, and I'm back with more earnings charts. I'm going to have all the hot names, all the ones you should be watching, those that actually have good earnings charts still. But we're kicking it off with the banks this week, as always. And I'm actually intrigued by the banks. 2022 doesn't look all that great, but 2023 is when things are going to kick in with those higher rates. But will a recession actually hurt earnings in 2023? Nobody knows yet. So people are cautious on these bank stocks, and they've come down big. Is this a buying opportunity in the banks? Let's take a look at some of these big banks that you should be watching to start earnings this week. So the first one out of the gate has to be JPMorgan Chase. And as you can see, they've had two misses in a row suddenly here in 2022. So things are getting a little shaky. Year to date, these shares are now down about 34%. And given that this is a 5-year chart, you can see it's starting to not look so good for 5-year investors. The shares are up just 9.5% during that time period. This kind of chart is an indicator that the banks are still in a bear market, but I think they're going to be coming out of one soon, and that this could be the last time we kind of stay in this narrow range. But while it's happening, it's still really painful, right? Shares are pretty cheap. PE of 9.3, price to book of 1.2. Remember what they say about the banks. You buy at 1 and you sell at 2 on the price to book ratio. So it's still on the cheap side. Also pays a dividend yielding 3.8%. So you are getting something for your pain, but how much lower does it have to go? We will see. Then we're going to switch it over to Wells Fargo. WFC is the ticker here. This used to be one of the hated of the big banks, the one that was out of favor, but it's not doing so bad this year. It's down only about 14% year to date. But over the last 5 years, it is down 22%. So that's where the out of favor part of it comes in. But if you were a more recent investor, it's not looking too shabby, as I said. PE is 10.5, price to book ratio is about 1. So this is on the cheap end. And so you buy at 1, you sell at 2. It too missed last quarter, and it too pays a dividend yielding 2.9%. So a bit under where JPMorgan is. But maybe if you're looking around at one of the bank stocks, Wells Fargo could be the one to put on your list. That's a change, and we'll see what happens this quarter. And then we're going to switch it over to Citigroup. They have a perfect track record. No misses in the last 5 years. Super impressive. But year to date, these shares are now down 31%. And over the last 5 years, now down 41% over the last 5 years. You have not been rewarded at all. It does pay the bigger dividend, yielding 4.8%. But your shares are going nowhere. Again, this kind of chart is indicative of a bear market. It keeps testing those lows there in 2020 and looks like it's doing it again. This one is dirt cheap with the PE of 5.8. Price to book is just 0.5. So it's not even at the 1 yet. And then you have to be asking, why is Citigroup so cheap? It has a lot of international exposure. People are nervous about that. So its makeup is a little different than some of the other banks. And all that matters right now with what's going on with the Ukraine war, internationally with currencies and trading, various things. You have to really dig down deep for these banks. So Citigroup, we'll see how much lower can it go. Maybe lower, but this is definitely one to watch. Then we're going to switch it over to Bank of America, one of the favorites, owned by Warren Buffett and Berkshire Hathaway. Year to date, shares down 31%. And 5 years, it is up. So it's up about 119%. 19%. Sorry, I was getting excited there at 119, just 19%, but it is up. So it has that going for it. PE is 9.6, price to book is at 1. So it's cheap too. And it's coming off that miss last quarter too. So all these banks, except Citigroup having some difficulties last quarter. We'll see what happens this quarter. Dividend yielding 2.9%, but Bank of America has been one of the investor favorites. Will it continue? We'll see. Then I'm going to wrap it up, since there's only the big four now, with one of the big regional banks. PNC Financial Services, one of my favorites, and it has a better track record. As you can see, it's beaten 8 quarters in a row now. And this one not down quite as much as a few of the others, but still down pretty big here in 2022, down 25% over the last 5 years, up 13%. But the shares too struggling. PE is 10.5. Price to book is at 1.3. So that makes it the most expensive out of these 5 banks, but still on the cheaper side of the equation. Remember, buy at 1, sell at 2 on the price to book ratio. Dividend is yielding about 4%. So pretty juicy here with some of these regional banks. These are the ones to watch if you want just kind of your run-of-the-mill banking and investment management and things like that, without like the more risky trading side of things that the big investment banks have. So PNC Financial, one of my favorites on the regional bank side, and it is cheap too. So as you can see, they're drilling in the apartment next to me. So just ignore that drilling sound, but it happens, right? That's good news for the economy that we're still getting home renovations. But as you can see, a lot going on with the banks. And I do feel like they're in that bear, like I said, but could be coming out of that bear. It's been 14 years since the financial crisis. They will come out of it at some point. You are getting some pretty juicy dividends, and earnings estimates are on the rise for next year. All 5 of these big banks have positive earnings growth for next year, except for Citigroup. That's why Citigroup's shares are the cheapest and struggling the most out of all these 5 banks, is because that earnings outlook isn't that great for next year. But the rest of them, double-digit earnings growth for 2023, if the economy can slow without going into recession. That will help the banks. And with some of those savings accounts paying higher yields now, more money might be coming into the banks just to keep it in the savings account. And when was the last time we saw that? It's been a long time. So I'm liking the banks here. They, are on track for this kind of market and these kind of market conditions. But right now, the pain is pretty severe. You could get some deals. We'll be tracking all the banks as we go along here, because there's more than just the big banks. I do like the regional banks and even the community banks here as we head into 2023, and they'll all be reporting in the next couple of weeks. So be sure to subscribe to get all of our earnings all-star charts. They will be coming out to you every week with, again, the best charts that you should be watching. What's happening with the FANGs? They're coming up fast too. So be sure to tune in. Get us all at Zacks.com/YouTube. And I'll see you again next week with a bunch more earnings charts.